Hello. Today we'll be looking at the concept of factoring. I remember I touched on this in my previous video, and this particular question that I want to solve today, FBX score. I solved this particular part of this question, the bulk of it actually, A, B, and C, in my lecture 3. Um, Today we will look at the deep part of this question because we've covered factoring in the previous video. So I want to solve a question on it so that you can appreciate it better. But before I go into solving this question, let me just give you a very quick reminder of what factoring is all about. Remember, a factor is that agent, that helps you to collect your receivable, right? So we spoke about different ways of managing receivables. We said you can introduce early settlement discount to encourage your customers to pay early and you give them discount, but that comes at a cost. We said you need to make sure that you do your credit analysis properly, so you check the credit worthiness of the customers before you even advance them credit. We said you can also introduce a cap or a limit to how much credit you make available to customers based on their credit capacity. Yeah, and I also spoke about the fact that when you sell, you should invoice as early as possible, and also prompt follow up on your invoices will hit uh, early collection. All of this we spoke about in the previous video. Yeah, but today factoring is a big concept, and I understand a lot of students actually struggle with solving questions on factoring. I've seen a student that says every time you will just pray that factoring will never come in exam because he has never gotten it. But when you work this with me, that has changed and factoring has become something quite simple. And that's what I want to do with you today. After today's solution I'm going to make for this video now, I bet you will find factoring very easy. So like I said, a factor is an agent, is a professional agent actually, that helps you collect your receivable. So they are debt collectors, but they are professionals. They know what they are doing. They've been in the business for several years. They are well experienced. So if you use a factor, you stand a better chance of getting your receivable collected. And that's one of the key advantages of using a factor. You can, even as a company, focus on your major core activities and not waste time on chasing receivable. Yeah, and sometimes you also reduce your admin cost and all of that. In fact, the best way to think about it is, remember when we talk about account receivable, we said the major reason why we need to manage account receivable is because we want to minimize the cost associated with account receivable. And we listed those costs. We said number one is the admin cost, which is the cost that the company incur to ensure companies in companies incur that cost to ensure that all receivables are being collected. So they will set up accounts receivable department and employ people there, and those people will be paid salary, right? So it comes with a cost to manage receivable. Another one is the bad debt cost. Yeah, because if you have a receivable, there is a likelihood that a certain percentage of that receivable will never be collected, and that's a bad debt that goes straight away into your expense. And that's loss of profit and eventually erosion of shareholders' value. And lastly is the finance cost. In as much as you have money uncollected, you have to finance that account receivable with an overdraft. An overdraft does not come free of charge. It's going to be charged at the interest rate applicable to whoever is offering you that overdraft service. So these are the three very popular costs associated to account receivable. So when you get a factor to help you with your account receivable, these are the three costs that you want to minimize. You want to minimize these three costs. But remember, there is no service that come free of charge. So when you employ a factor to help you collect your receivable so that you can minimize this, that factor will charge you a fee, and that is called the agent fee, or you call it a factor fee. Yeah, because factors are not philanthropists. and they don't run a charitable organization, so they will charge you for it. Yeah, and that's what we want to look at today. And there are two types. Let me just quickly tell you two types of factor. Yeah, basically you have factoring with recourse and factoring without recourse. Let me explain the difference to you. Yeah, with recourse means that when you give account receivable to an agent to collect for you, if you give $100 million worth of account receivable to this guy, if he's able to collect the 100 million, fine, you are okay. But if he's not able to collect more than 70 out of that 100, he's going to return back the 300 to you as bad debt. So it's not his problem, it's not his business that he's not able to collect everything, but the only thing is he will collect as much as he can. So you're not guaranteed that all your receivables will be collected when you get a factor with recourse. So with recourse means you can come back to me, you can return the receivable back to me if you are not able to collect the receivable from customers. And the opposite is without recourse. So without recourse, once you give the $100 million to the agent and you agree on how much he's giving you, if he's giving you 80 or 90 for that 100 and the balance probably you say is his own fee, then the next thing is for the factor to go out and collect that money. If he's able to collect that money, good for the factor. If he's not able to collect that money, bad for the factor. For without recourse, all the risk have been fully transferred to the factor. The company that has receivable does not have any exposure to collection risk, no more default risk. So in that case, for that company that uses without recourse, bad debt is usually zero. And let me just quickly put it down. So this is this will help you to reduce bad debt, but cannot eliminate bad debt because if he's not able to collect, it will come back to you. But without recourse, will eliminate bad debt for company. So bad debt will be eliminated. So if you see it, you realize that without recourse is really a better service, and that is why it's usually more expensive. So it's good to know the difference between these two, and this is cheaper. Yeah. So another way to say it is that company retains default risk, but for without recourse, there is no default risk because every risk of collection has been transferred to the agent. So very important to note, just have a feel and a revision of what a factoring is all about and what a factor agent does and the types of the factor agents you can employ in your company for collection. Now let's dive quickly into the question and work with that. And I will encourage you to use this format that I'm going to use for you. Yeah, in all my videos, what I've always tried to do is to break things down in the simplest way and the easiest way you can really understand and solve those questions yourself. Yeah, no factoring calculation is something you have seen in different shade sizes and shapes, and everybody solving it the way they like it. I've seen the ones I like, I've seen the ones I don't like. Yeah, but I've come to develop this approach, which will also give you your full marks if you use it in your exams. And I advise you to use it because it's simple and makes life easy for you. So anytime you see a factoring question, before I even read this question, remember the question is really all about should we get a factor or should we not get a factor? Or the question might say, should they get a recourse factor or without recourse factor? So usually you comparing two options. So anytime you have two options in this paper, finance management, always think about what I will call cost benefit. Yeah. cost benefit analysis. So which means all you are trying to see is, okay, what are the costs associated to this and what has happened to this cost? Has it reduced or has it gone up? So you are doing a cost benefit analysis, or you can call it cost comparison. Yeah, between the current state and the proposal. Yeah. So for this factor now, let's go into the question. Remember this question, FBX? Yeah, we have the financial statement and we've done the operating cycle part of this question. And if you just read the question from the director, right? So the director of FBX have been pressed by the bank to significantly reduce the overdraft. Yeah, so they are being requested to reduce their overdraft. And what does that mean? It means that they need to find a way to collect their receivable as their own cash. But some of the directors wish to do this by reducing the operating cycle, cash operating cycle, which is the part of the question we have done. And they have set a target of 50 days of inventory receivables days, each being reduced to 45 days. Yeah, so that's a way of reducing your overdraft. You can make sure that you collect faster, reduce your cash operating cycle, increase your account payable days if possible, to also reduce your cash operating cycle. So all of that, remember we dealt with it in the lecture 3 when we saw those A, B, and C. But now look at this part. This is the part that is now the part we are going to be looking at now in this video. Said another director, yeah, here, this part. So another director would prefer to outsource collection to a third party and has approached a factor, right? They have promised to reduce receivable days to 35 days. So the receivable days that used to be uh, more than, when we calculated it last time, I think it was about 60 days or so. Yeah, but I knew we did it the last time, but they want to set another target. Initially, they wanted to use a 45 days target, yeah, to reduce the cash operating cycle. But now they're even saying, no, we are not going the route of cash operating cycle. Let's get a factor. So a factor has said the new account receivable days, yeah, will now be 35 days if you give me the job. And guess what? He also promised, so he offered to also provide the service on both with the recourse and a non-recourse basis. The charge will be 0.5. You can see it's charging 0.5 and 1% of revenue respectively. So which means if you employ the agent on with recourse, it's going to charge 0.5%, but if it's going to be without recourse, it wants to charge 1% of your revenue as its own fee. Because like I said, it's never going to be free of charge. It comes with a cost. So now, in addition to that, as a condition of this offer, they have stated that they will make an advance equivalent to 75% of the revised trade receivable. Remember, because the account receivable days has changed to 35 days, then there will definitely be a revised account receivable balance that you will expect. And if we do that quickly, remember the formula that we use. Let's get what revised balance is. So account receivable days formula is equals to account receivable balance divided by sales times 365. So the revised AR balance will now be equals to sales, which is 4850. Let's be sure. Yes, yeah, 4850 multiplied by 35 days and divide by 365. And that will give us the revised receivable days. I'll use the calculator quickly. The revised receivable balance. That will be definitely much less than what we used to have. Before, receivable used to be 780 on the balance sheet. But with this proposal of 35 days, our receivable balance will go to 465k dollars. Right. Yeah. So we're making progress. So now we know that our revised account receivable balance is 465. So in this question, they're now saying that as a condition, yeah, of this offer, they have stated that they will make an advance equivalent to 75% of this figure, but at 7%. So advance is cash. So remember, they want to collect your receivable, and instead of you finance those receivables for the 35 days that you are waiting to collect, because they said they will need 35 days to collect, you still need to finance the receivable. But they're saying don't go to the bank, because if you look at it, this company usually goes to the bank to get overdraft at 5%. Yeah. Yeah, and even overdraft of 780, because remember I told you your overdraft, you always need the overdraft that is equivalent to the amount of your receivable. That should always be your assumption, even if it doesn't look this obvious in the question. Yeah, you must always assume that a company will need the same amount of overdraft as the account receivable balance that it has not been able to collect. So, but instead of collecting the overdraft from the bank at 5%, this factor is saying that you need to come to me to get your 75% of the revised balance at 7%. So it's charging 2% extra. So which means the remaining 25% of your revised account receivable, you can finance it the way you like it. You can go back to your bank overdraft at 5%, but 75%, I will be the one to provide it, and I will charge you at 7%. They do that almost all the time because the factors just want to also make money. Yeah. So they want to make sure that beyond their fee, they are also being able to make some interest income. Yeah. So the director believes that the factoring agreement can lead to administrative cost savings of 15,000 per year. And you can see it. We spoke about the fact that three costs are the most popular costs that are attributable to having an account receivable. And you can see it already. They said they will take care of these admin costs. It will be saved, about 15,000 will be saved on that. And likewise, bad debt incurred in the most recent financial year currently at 0.75%, and this can be reduced to 0.4% if the factor takes over the collection. So you can see currently we are doing a bad debt of 0.75% write-off every year. That is loss. But they are saying that loss will be reduced to 0.4% if the factor takes over the collection. And remember, the factor takes over the collection under a non-recourse basis. In fact, your bad debt will go to 0%. Yeah, so this 0.4% is only applicable to without recourse. No, with recourse rather. If it's without recourse, then the bad debt is zero. Please take notes as I mentioned here. Because we do without recourse, you eliminate bad debt because there is no more default risk for the company. So now that is the gist in that question. But what's the question? D. Say calculate the net financial benefit to the company of employing the services of the debt collector, the factor on both recourse and non-recourse basis, and comment on the acceptability. So three things involved here: the benefit of using recourse, benefit of using non-recourse, and acceptability. Those three things we must remember to talk about them. So now look at the format I'm going to use for you. You probably not see this anywhere. I'm not sure you will have seen it anywhere, but it's probably the simplest way of dealing with factoring questions. And I bet with you, you will thank me later for this. So the first thing you will do is when you have a question like this, just prepare a 4-column table. Watch me. Yeah. So you're going to have the cost attributable to financing account receivable. Remember, we said There are three major costs. There is admin, there is finance cost, there is bad debt, and because we are employing a factor now to help us, and that job is not free of charge, there will be factor fee. So for all these four costs, you're going to do this for me. You're going to ask yourself, what is the current situation? The current cost, the current amount. If we do with three costs, what would those be? Get the total cost here. And without recourse. And let's see. So your objective is to see the total cost under each of these circumstances. And with that, you will see the benefit over the current situation for each of those two options. Because this is current, this is option one, and this is option two. Right. So this question has already told us that there will be 15,000 administrative savings. So which means currently we are incurring 15,000 costs. And if you do factoring, this goes to zero. We are not going to incur anything again. There will be savings on that. Currently, how much is our finance cost? Remember I told you finance cost. So let's do calculation separately. So for finance cost, let's do calculation. For current situation, it's going to be 5%, which is the overdraft, multiplied by the 780,000. Let's check. Yes, 780 trade receivable, 780. Fantastic. So 5% of 780k, and that will give us 39k. So let's work in thousand. So I'll change that 15,000 to, sorry, excuse me. Yeah, here. So I want to change, I want to work in thousands so that's easy to manage. So this will be 15,000. Yeah. And finance cost currently is 39,000. But with free cost, what will be our finance cost? It's still going to be interest rates times principal, but this time around, our factor said he's going to finance 75% of the revised receivable. So remember, once we go for a factor, our receivable will no more be 780. It's going to be reduced to 465,000 because the collection days will have been reduced to 35 days. So it means that we're going to have 75% of our trade receivable revised, which is times 465, being financed at 7%, and 25% of that revised AR will be financed at our normal rate from the bank, 5%. We had all of this together, so that will give us 30.23k. So, and this will be applicable to whether recourse or no recourse. So that's the same figure, 30.23, 30.23. So actually, we can see that the factor has reduced our finance cost, it has reduced our admin cost. And let's look at bad debt. Currently, bad debt, the question says, is 0.75% of revenue. So for current situation, that's 0.75% multiplied by 4,850, and that will give us 36.38. So that's bad debt. currently 36.38. Or if we go with recourse, it's going to go down with to 0.4%. So that's 0.4% multiplied by 4850, and that is going to give us 19.4. So 19.4, bad debt has also been significantly reduced. What a factor, guy. Doing a great job. But let's see whether his fee will justify those benefits. Now, without recourse, bad debt, as we said, is always going to be zero. Factor fee, currently we don't have a factor, so it's zero. And with recourse, it said it's going to charge us 0.5% of, let me do factor fee, current is zero. But with recourse, oh, this is what, because I'm without, number is the same. Bad debt, we've done that. So factor fee with recourse is going to charge us 0.5% of our revenue. So that's 0.5% of 4850, and that is going to give us a fee of 24.25, 24.25k. And without recourse, that is going to be more expensive because all the risk of default has been transferred. And that's why it's charging us 1% of revenue, which is 48.5. This will be 48.5. And with recourse, we got 24.25. So now we have all the total costs, all of them here. Yeah, adding the current situation together. So currently, to manage our account receivable, we are incurring 19.38, 90.38 to manage account receivable. But if we go for a factor with a recourse, it would rather be 73.88 as a cost associated with account receivable. And if we go for without recourse, add all of that together, the total cost of managing receivable will be 78.73. Now, we have calculated the cost associated, but what are the net benefits for each of these options? So, if we decide to do with recourse, it means our cost would have reduced from the current situation of 90.38 to, excuse me, 73.88, and that difference is about 16. So we have a savings of about 16.5 savings. And if you decide to go for without recourse, we'll have a savings of about 11.65 because we would have reduced our cost associated with having account receivable from 90.38 to 78.73. And you can see that is the net benefit that we have been asked to calculate by this D, right? So we've calculated the net benefit on both recourse and non-recourse. Now, comment on acceptability. Yeah, so as you can see, the way you comment on your acceptability needs to be very quite holistic because you've done three calculations actually, and you don't just say it's good because they are net benefit and accept. You say something like this: looking at the current situation, FBX could currently incur about $90,380,000, yeah, on managing his account receivable. But if he decides to employ a factor agent, whether on recourse or no recourse, his situation will be better, because with recourse it would have saved 16.5k, without recourse we have saved 11.65. However, because with recourse we give the higher amount of savings over the without recourse, FBS Co is advised to employ a factor and employ such a factor on a with recourse basis. Then you get your full marks. So you see the way I've moved. I've spoken about the fact that currently we're at 90. If you get a factor, we will have a reduced cost, whether it's recourse or not recourse. However, go for with recourse, because with recourse gives the highest amount of savings. And that will be it for this question. If you like the way I've solved this question, I would like to hear from you. Or if you have any comment or if anything is not clear to you, please feel free to ask questions or put your comment, like the video, and please, most importantly, remember to follow, share the links as well with your friends. And very soon I'll be asking your opinion to tell me which paper you also want me to start taking in addition to this, because very soon I'm thinking I want to pick another paper of ACCA and start doing the videos as well. Nice having you guys, and thanks for sticking with me. Bye for now.